Welcome to the latest Goals-Based Investing podcast series. I'm thrilled today to be joined by my good friend, Aaron Filbeck, as we talk about the portfolio of the future. Aaron, the timing couldn't have been better. The world is changing and people really need to think differently about building portfolios.
Absolutely. And thanks, Tony. I'm happy to be here.
We look at the world today, we see a world where the anticipation is returns are going to be lower in the future. Equity returns are going to be lower. We've come at an environment where yield was near zero. And even though it's moving up, it's still a challenging yield-oriented environment. Volatility is spiking with a lot of unknown events around the world. And of course, this new phenomena that we haven't had to focus on, but is driving a lot of the decision-making, and that is inflation. Is that how you see the world? And if that is how you see the world, how do we navigate?
Yeah, absolutely. And maybe just to back up the genesis of this paper, I think you said it well. I mean, you take a look back over the past, I'd say 20, 30, even 40 years, and you've had this environment that's been very friendly. You've had falling interest rates from 15, 16% back in the 80s to today, where at one point it was sub 1%, maybe approaching 50 basis points on the 10-year Treasury. You've had low inflation, you've had a pretty accommodative monetary policy, strong equity markets, especially over the past 10 years or so, and this perfect environment for an investor to kind of hit the easy button and really not have to do a whole lot. And I think our timing couldn't be more perfect. I wish we could manage a large portfolio based on the timing of this paper. Just given what's happened in equity and bond markets, especially in 2022. But we basically said, okay, now that we've been in this period of low inflation, falling interest rates, rising equity markets, we don't necessarily think that will be the case moving forward. And so what does the portfolio for the future really look like? And as part of this piece, we tried to introduce what we thought were the 5 marks or 5 characteristics that would really define that portfolio.
So let me just take a little bit of a step back, and something you said really resonated with me, and that is that we had a perfect environment for the last 10 years, and advisors could hit the easy button, put that 60-40 portfolio to use and say, Mr. Client, Miss Client, you're going to be just fine. And it worked well. But tomorrow is going to be very different than yesterday. And tomorrow we do need this more futuristic portfolio. So walk us through what are the elements of the portfolio of the future. And I know you've got those 5 elements, and then maybe go slow so we can talk about each one in a little bit of detail.
Yeah, sure. I'll go through each one, and maybe we can pause after each one. So as we think about maybe where we are in the market environment, the 5 characteristics or the marks that we think define the portfolio for the future. First and foremost, and this is probably pretty well known, but broadly diversified. So as you think about putting together a portfolio of asset classes and strategies that have different risk exposures, different cash flow characteristics, and different drivers within your portfolio, diversification is back. And the easy button that was there 10 years ago isn't necessarily there today. So whether that is kind of exposing yourself to inflation, different income generation, or just better downside protection, diversification is here to stay.
And I love it because yesterday's playbook, that old 60-40 portfolio with just stocks and bonds aren't really going to cut it, which ties into certainly a lot of the work that CAIA has done over the years and just helping to pioneer and democratize alternative investments, which are these multifaceted tools. I suspect alternatives play a significant role in helping to increase the return, dampen the volatility, find income, and hedge the impact of inflation.
Yeah, absolutely. And we've done some work on kind of looking at the industry as a whole and kind of what's the total investable market. And alternatives kind of used to be this esoteric piece of the portfolio where get a little bit of octane in your overall asset allocation, and you're good to go. And we, from a diversification standpoint, we view alternatives as more core, more than anything. And equity is equity, whether it's private or public. Debt is debt, whether it's private or public. And then you've got real estate, infrastructure, commodities, more inflationary portions of your portfolio that need to be a core piece of what you do. So being at CAIA, we're obviously educating on this stuff, but we do think it's an important piece of that broadly diversified mark.
So we've evolved from nice to have to need to have, right?
And that's a good way of putting it. It's a good way of putting it.
What's the second mark?
Yeah, the second mark, and I think plays into the last comment, is less liquid. And so really over the past 10 years, you haven't needed illiquidity. Liquidity is kind of one, especially here in the US, where you've only needed to own a small number of individual stocks to do really well. And public markets have kind of led the charge over the past 10 years or so. But what we've noticed in the private markets, especially, is that capital formation has really shifted in favor of private markets in particular. And there are a couple of good examples of early stage companies that have really generated and created value in the private markets, and have either decided we're just going to stay private entirely, or if we do go public, we're going to wait for a really long time to actually do so. So we think looking at illiquid and being less liquid in your portfolio is ultimately a characteristic that will define that portfolio for the future.
And I think what you're saying is the illiquidity premium is here to stay. And I think many advisors are too fixated on being liquid all the time. And if you have the wherewithal to tie up capital, you should be rewarded for doing so. I love it.
Yeah. Yep. I think that's a fair statement.
Good. The third mark.
Yeah, the third mark, and I think this ties in nicely with some of the work that you've done, Tony, is this concept of being rooted in a fiduciary mindset and really trying to sit on the same side of the table as the client and acting in their best interests. And I think that starting with what the client's goals and objectives are, what they're trying to actually accomplish within their portfolio. And I've actually got your book sitting right here on the desk. There we go. You can see it with the background now. Where I think that you really have to start with what the client's trying to accomplish, be a fiduciary, sit on that same side of the client. And we're an agency business. We really got to, as an industry, make sure that the products and the way that we're thinking about portfolio construction ultimately benefits the people that we're serving, which are those end investors.
I think such an important message. Thank you for that.
Yeah, and maybe going on to the fourth kind of mark of what we're trying to accomplish is this concept of actively engaged. So over the past 5 years or so, there's been a lot of discussion around environmental, social, and governance, or ESG investing, and we really take this a step further. And I think this is especially true in the institutional world, but I think clients and financial advisors have a role to play of actually being more actively engaged with the underlying companies that they own, and investing with managers and those managers who are engaging with corporate governance practices and executive teams at these organizations, and really trying to not only benefit the shareholders, but also the stakeholders that are within those companies or even external to those companies. So going beyond just kind of the ESG moniker, but really starting to get more active with trying to create those better outcomes.
And I think that's where the industry is going. I like the way you framed it, being actively engaged, because I do think that is part of the value of an advisor, is engaging their clients, understand how they feel about these sort of issues, and whether there's an opportunity to align the purpose in the portfolio. So I love that one. And then your last mark.
Yeah, the last mark is dependent on operational alpha, which it's kind of a word salad in some ways, but I think the bottom line is it comes down to decision making. So whether or not you're at an institution where you're reporting up to a board who's approving the investment portfolio, or if you're an advisor at an RIA or some other wealth management firm working on an investment committee and working with the advisors and an investment team trying to put together the portfolios for the clients. How are you making decisions the most efficient way, and in a way that's going to not only improve the investment performance, whether or not that's through manager selection or otherwise, but actually trying to make allocation decisions in a more efficient way to react to current market conditions.
And I think that's such an important issue because, I've certainly seen in the industry, as you have, advisors spend an awful lot of time thinking through the big mosaic of what they want to do. Here's their asset allocation. Here's their manager selection. Here's the lineup. Here's how we're going to monitor them over time. But sometimes the implementation lags a little bit. And sometimes, to your point, they don't have that operational efficiency built into it. It gets a little bit clunky, especially when you get into periods like this where it's volatile. You may want to be more tactical. You may want to be rebalancing portfolios. To do it in an efficient manner across a book of business, and some advisors have very large books, I think the operational efficiency is going to determine whether you're successful in matching your ideas in your portfolios, or there's going to be a little bit of a lag. And I would imagine technology plays into that quite a bit.
Absolutely. Technology, reporting, rebalancing software. I mean, I think all of these things make the experience better for the client, but it also makes it, to your point, Tony, much easier to actually make some of these decisions and move quickly during different market environments.
So Aaron, I love the paper, and again, I applaud you on the timing. I think it's really well done. I know you've also leveraged a lot of industry experts to kind of get thoughts on this. What is the expectation of CAIA with this paper? Are you trying to change the industry or change the way that we think about portfolios? And how can we measure success over time? Is it going to be something as simple as starting to see more of a broad adoption of alternatives, or is there a different sort of thing that we should be looking at?
Yeah, to maybe to your first question, I think what we're trying to do here is change the framework by which people think about investing. And that can take shape in a variety of different ways, whether it is, broader adoption of alternatives or not. We're really focused on improving investor outcomes. So however that portfolio might look is dependent on the individual client, the goals that they're trying to accomplish. But that's our mission. So really trying to take us from the past 10 years where, again, back to the easy button comment, we've got to be a little bit more dynamic. We've got to be able to recognize that the market environment and the factors that were there in the past may not necessarily be there as we move forward into the future. And so hopefully this paper lays out a roadmap for those advisors who are serving those clients to think a little bit differently about their portfolios.
Aaron, thank you so much for sharing this research. We're going to provide a link at the end of the podcast. I would encourage everyone to read the paper. What I like about it is all of these things are things that advisors can embrace. It's not like we put a roadmap out there and they can't get to the destination. They can clearly think about embracing alternatives. They can clearly think about aligning portfolios and purpose, wrapping everything around a goals-based framework. And then, I think their premium is helping clients in difficult periods of time. The easy button comment is applicable for advisors and investors when the market goes straight up. But in this environment, this is where advisors really earn their premium. And I applaud you for the paper and the timing. Aaron, so nice for you to join me here today. We'll have to do this again in the future.
Thanks, Tony. I really appreciate the conversation. Always good to talk to you.
Very good. Thank you.